Hello, everyone, and welcome to the Always On Point podcast with Kristen Ambos. One of the things that we are going to discuss today is credit, all things credit, and it's really important. This is a hot topic for a lot of people, and I wanted to go over the good, the bad, how do we build credit, and those types of things. Now, I am not a credit expert. I do not work for a credit repair company. I'm just giving you the knowledge and tidbits that I've received over the years, almost 25 years of being in the business and how I've seen people's credit work and what I do know helps. And so first and foremost, yes, I do agree with Dave Ramsey that you don't need to have credit cards at extreme interest rates and levels to live life. So I will give him that. However, on the lending side, he does really preface the fact that cash is king. Cash is king in a lot of ways, and it's very good habit to get into. But where it can falter you, and one of the things he doesn't touch a whole lot on, is the fact that, yes, you can buy a house with no credit. However, because you're a cash is king person, which a lot of people are, still deal with them, both young and older, with that cash is king, we don't know if you pay that bill with cash on time. Do you pay it late every month? We don't know what that looks like because it's not being reported to the Bureau because you are paying cash. So what a lender's going to do is they're going to say, okay, you can purchase with no credit. We're going to look at probably a little bit more money down. And then we're also going to need either 3 trade lines proving you've made payments on time to build you a credit score, or we're going to look at your credit as the lowest score available, which is a 620. Now that 620 score will affect your interest rate as well as private mortgage insurance if you need it. So that's where, yes, you can buy, but it becomes more expensive to you. So what's the alternative? Well, the alternative is building credit. And for people out there who don't know how to build credit, there's actually a really easy way that you can do that with your own money. Because a lot of people are scared of credit cards, and I don't blame them. Listen, I watched my credit cards that I have go from, 2 to 3 to 5% all the way to 33, 34% in this last 5 years. It's a big jump. And so borrowing money from a credit card can be extremely expensive. So proceed with caution when doing so. And that does make a lot of people scared. And with that being said, one of the things you can do that's the easiest way to do it is with a secured credit card. Now, what does that look like? You go to your local bank, and I did this with our own daughter. We did this when she was a senior in high school. And, I'm that mom that said, hey, listen, we're going to make sure you have a credit score, but I'm not giving you one. I'm not just going to sign you on to all my cards so you have access to everything. But what I will do is I will give you the tools to build your own score. There's a twofold on that. One, because when it's a score you build yourself, you protect it with everything. And it is yours, and it's something you can build and something you can take away from you, but only you can do that when you have full, responsibility on it. So that was the bigger one. And 2, because I wanted her to be proud of the work that she was doing on her own, instead of just being flippant about it, like, well, my parents gave me a credit score. It's really good. So, that's fine. So it was twofold. It was 1 for her to grow in independence, and then 2, so that she would protect it for the rest of her life. And, whether you agree or disagree with that, people have all different feelings. You can add a child to one of the credit cards you have if you're a parent right now. Or if you're somebody without credit as a child, you can go to your parents, grandparents, and ask them to be a user on their credit card, in which case then, you take on that credit responsibility. And a lot of times it's good. So you can gain a score quickly. Again, I lean on the secure credit card for those people out there who don't have a family member to lean on like that, or who simply just want that independence of doing it on their own. So you go into your local bank, you ask them for a secure credit card. The security of that credit card is your own money. So I'm going to use the same example we did with our daughter because it's one that we've personally tried and true for us. And so I want to share that with you. So she took $300 of her own money. It doesn't have to be a lot. She took $300 of her own money, We opened up a secured credit card for her. Now, teaching them how to use the credit is the second piece of this. So with that being said, we taught her you never go over 30% of that limit. So whatever 30% of that limit is, that's what you use. With that being said, you want to pay it off as quickly as possible. However, if you pay it down to zero every month, that's going to keep consistently saying zero, and then credit bureau agencies are going to not show a whole lot of revolving. You can pay it down to zero. I suggest that. For everyone with established credit, obviously I'm going to lean on that being the key factor is to pay that credit card off. However, if you're building credit, a lot of times what works the best is if you pay it down, but not completely off. And by that, we taught her to leave $10, $20 on the card, pay the rest off. So she would pay for her gas, and then she'd pay the card down right away, leaving $10 to $20 on it. One, that was the least amount of interest that she had to pay. And two, that gave her the ability then to just have a small balance showing she could responsibly use that card to the bank. Now, with the credits, they continued to do that. Within about 6 months, she had herself up to a 680 credit score, and shortly after that, she was over a 700. So it does work by doing that, but you've got to keep those key factors in line. Never use over 30% of the available limits that you have, and two, pay the card down to as low as you can, leaving a small balance on there so you're paying as little interest as possible. That small balance will keep the credit revolving. And with that said, that's where you can gain your credit score because you're showing your responsibility into making those payments. That's what a lender is looking for. We always err on the side of caution, and we always look at the risk. And if you've now got a higher credit score because you've shown to credit bureaus that you can responsibly use money, whether it belongs to you or not, then you are now showing a lender that you can pay responsible. That's what we want to see. We want to minimize our risk and just make sure that all the payments that we're going to ask you to make on the house, you're going to make. It's always kind of funny to me because it's one of those things where people in the background say, oh, the bank just wanted my house. The bank just wanted my house. They wanted me to foreclose. I'm here to tell you that that's the exact opposite. As a lender, we want you to pay us. We want you to pay us on time. We don't want you to foreclose. We don't want you to miss payments. And we certainly don't want to charge the fees to do so. So we want to help. And one of my ways of working with that is working with people of all credit ranges to get their credit up. And now, in my daughter's experience, she is so proud. Like, she'll call me and be like, KK, she's my stepdaughter, but KK, can you believe that my score is now 720? And she's so proud, and hearing her proud on that end can happen. Now, she started with nothing. She started with no score, and in less than a year, she had over a 700 score. So if this podcast is screaming to you or somebody you know on just getting started, we would love to help them with that. We're a team that says there's no credit score we won't work with. However, we may need to do some credit repair in order to get you there. Now, again, I'm not a repair agency. I don't have a license to do credit repair. This is just tidbits that you can take into your own hands and improve your score without paying astronomical fees to some credit repair companies or things like that. So that's the first tool that I wanted to share with you today. The second tool when it comes to credit is, yes, your interest rate is revolved around your credit score in a lot of loan programs, especially conventional. Your conventional loan programs really weigh the rate on the risk of the credit. Now, back in the day, 680 was a phenomenal credit score because credit only went up to 750. Nowadays, it goes up to 850. So 680 can be that mediocre area. The area you really want to get to is 740 and above, even 760 and above. That comes with a lot of time. So that's a lot of time of proving that you can make those payments on time. That's a lot of time of sharing and showing. So if you get an opportunity, there's three areas where credit is going to be necessary to get to those levels. The first one is revolving. That's what we talked about with the secure credit card or an unsecured credit card like a Capital One, just a Visa, MasterCard, a store credit card. Those are unsecured. Your secured credit card is using your own money. Two is an installment loan. An installment loan is going to be something that you take a loan out on and you make the same payment every month until it's paid off. So think of an auto loan or a student loan, something to that nature. If you have a toy, maybe an ATV or a phone or something, those are installment loans. Those will also help your credit score go up, proving that you're making the same payment or more every month while you're paying that loan down. The third is a mortgage. The mortgage that you take out is the first and foremost, type of credit or liability that you have that can make or break your credit score super fast. If you have a mortgage and you're making that payment on time every month, your score is going to shoot up within probably 6 to 12 months after you take that mortgage out. Now, if you miss a payment on your mortgage, that's also going to hurt you the most. So you've got to be very careful on making that payment. That's another reason why, as a lender, we look at all the options and all the pieces of the risk, because we want you to use that mortgage payment as leverage to, one, increasing your score, but two, to also ensure that you're going to be able to pay that every month. So that's where those three, combinations of having a revolving, an installment, and a mortgage is going to maximize your ability. So just to recap, the things we talked about today is only using 30% of your overall utilage of cards. Let's say you have 3 different cards and they equal $1,000. You don't want more than $300 on any one card or the 3 combined. So hopefully that makes sense. You're going to take your overall limit and you're going to take 30% of that. And you're going to utilize that amount or less in order to maximize your score. 2, secure credit card over unsecured credit card all day long will help you build that score. 3, utilize a lot of different liabilities when it comes to revolving, which is credit, installment, which is, for instance, a car loan, and then a mortgage, eventually a mortgage if you would like to take a mortgage out. Those are the 3 pieces. So would love to have a further conversation. We will bring more credit to you. But right now, I just wanted to get that info to you so that we have a starting place when we talk about credit and some financial literacy within this podcast. So any questions, drop them below in the YouTube chat. Otherwise, feel free to reach out. We are at ambosteam.com. Would be happy to help you. And thank you again for listening to our podcast, where we hope that you like, share, and subscribe moving forward. Have a great day.